for VC Fluency 6 exit analysis. If you recall, in session 5, we went over IPOs and M&A, building the story and comparables analysis, which is very relevant for today's topic since those comparables feed directly into the exit analysis. So today we'll be going over assumptions, 1, 2, continue building the story, and 3, the simple and the VC exit analysis. So in terms of the example we'll be going over today, we're going to continue upstream, which we covered in the last lecture. Here we're going to pretend that we invested $70 million in the last round. We're assuming a post money of $700 million, which is assuming the $140 million the investor money is 20% of the company. So that means we own 10% of the company presently, and we have no plans to follow on. Again, if you recall, the simple story is like we believe the company exits at X valuation after D dilution. And we use 80% for the dilution assumption. So I expand the comparables here to get a more robust story. You can see here median valuation of $4.3 billion, 8 years of exits. There was a mix of IPOs and acquisitions. So let's build a story. I built 2 stories. One is the M&A story. So I believe that upstream could raise an additional round of financing, so 1 round dilution, and exit at $1.5 billion. As you can see, there's lots of acquisitions in this $2 billion range. Markets have gotten a little cooler since this, so I thought $1.5 billion is fair. Second story is the IPO story. I believe that upstream will raise 2 additional rounds of financing, so 2 rounds of dilution, 80% each, and the markets will recover and it'll be a $3 billion IPO. Here it's interesting because you see acquisitions be higher than IPOs, but almost in all cases, IPOs tend to be higher than acquisitions. So again, sometimes you need to modify the story to match up with your common sense. So the first step is dilution, right? And you can make a simple table with how many rounds of financing equating to that times 20% to get what the dilution assumption is for the exit, and also your initial ownership, which is 10%. So here's a simple one, right? It's just a table, right? So on the left, you're getting the final ownership, which is just the dilution assumption multiplied by your initial ownership, right? And we own 10%. So if there's no rounds of financing, it'd be 10%, 1, 8%, 2, 6.4%, et cetera, et cetera. And then range of exits. Since we're assuming that upstream's already valued at this 700 million number, basically you need to exit $1 billion for investors to be happy. Even like a $750, $800 million would not make the last investors that much money. So that's why I started with $1 billion here. And you can see the plot of different range of exits times final ownership. And I highlighted a few relevant ones as well. Also, I'd like to point out that you can do this from the operator perspective, right? Like 0.1%, 0.01%, so that 10% number. So another way of thinking about this is that 120 million that's highlighted. If you're an operator of 0.1%, that'd be 12 million. If you're an operator with 0.01%, that would be 1.2 million. That would go into your pocket. Also, some math. The multiple final over initial, sometimes called the cash on cash multiple. The return, ROI, return on investment, finance my initial, divided by initial, internal rate of return. And this is inserting time into a return calculation. So it's the cash flows in and cash flows out, weighted over time. There's an IR formula that makes this really easy to do. You just plot out what the cash flows are over time, make sure to include zeros, do the IRR, and it spits it out. So we're seeing here the M&A story. This is a $1.5 billion exit, right? So we're seeing the multiple of 1.7, ROI of 71%, and ROI 14%. And that's corresponding to the 4 years. On the IPO story, the multiple is 2.7, ROI is 174%. And then the IRR is 13%, 8 years, which is interesting because IRR ends up being very similar due to the time component of this exit being around 2x, but also taking 2x amount of time. So it roughly evens out. So that's the simple method. Now to go into more of the VC method. This is a modified version of what I showed you earlier. So here we're still using dilution assumption to make our lives easier. But then on the exit math, we're going to use revenue and multiple in order to come up with what we think is a more accurate portrayal of the world. And this exit valuation is going to be the Y revenue and the Z multiple. So the revenue forecast is a tricky part here. It's very tricky because you almost always have incomplete information. Like as an investor, you'd have a data room and you would have all the revenues. You'd have how many customers they have. Here it's probably primary care physicians. You'd have some growth rates. You'd have some historicals that you could use to calculate projections. I didn't have any of that, so I just did some guesses, right? So primary care physician market is 123K total primary care physicians. 1% of that is 1.237. And I'm just assuming that the revenue per practice is 100K. So in 2024, that equates to revenue of 123 million, which feels that could support like a 700 million valuation. And I'm just going to assume that we're going to grow the practice at 25% per year, and the associated revenue grows with that. Again, this is an assumption, right? A more accurate assumption would probably be that there's faster growth, maybe 25, 50% the first few years, and then it gets a little slower. Maybe it's 10 to 25%. But for this calculation, not having complete information, I think it's a good guess. So here we have in 6 years, it'll get to $471 million in revenue. And also this is something that you should check with comparators, especially if you have any information with the revenue of comparators of the exit, and see if that seems to make sense in terms of, okay, when was the last time they fundraised? How long did it take to get an exit? What was the revenue of the exit? What was the growth during the last fundraise to the current exit? And this is something that you can massage. And oftentimes, I think it's best to over-index on one comparator that seems to tell a good story, maybe two, versus trying to like use averages for everything, because then the story gets muddled. So here's the final robust exit analysis. I have this template available too. I created it in my VC days using fellow VC friends templates. Everything here is stuff that we've covered, just format it's structured a little differently. But we talked about the initial investment, the pre-money, post-money, what the ownership is, the multiples I got from that table. So I have a base case of 3.5, a best case is 7x, 1.25 conservative. I then have that, and then inserted the revenue. So that's what you see here. And using the 471, which I thought was an accurate or a good guess that you could get to within this time frame, you see that the exit price base, which is just a 471K times the 3.5 base case, is this 1.6 billion number. Then you see what the return is for us, and that's this 132 million number. And that's because we don't own 10% of the company anymore. We own 8% of the company, since there's one round of dilution that we're assuming here. Now we also have the cash on cash multiple here, the 1.9x, and the ROE of 17%, which is a bit higher than in the simple method that we used. I think the main benefit of using the revenue here is it does make you really think about the world, and does this make sense? And that's something you need to ask yourself constantly as an investor, since you are using your crystal ball in order to forecast what the future world and returns look like. So as you add layers of analysis and different components of it, it gives you more opportunities to ask yourself, does this make sense? What do I need to modify? Is there something else I need to modify elsewhere, whether it's in the revenue? In later stages, you also look at costs, or maybe maybe you need to look at more comparables. There's a lot of things you can do in order to hone on into a better estimate. So that's it for BC Fluency 6 exit analysis. Hasta luego. Bye.